Gloom and doom, gloom and doom, gloom and doom everywhere. Hello, my YouTube friends, and happy Saturday. Today is October 12th, I think. My God, year's just flying by. I can't believe how quickly it's going through. I'm going to talk this week about everything we saw in the markets, which, again, all the gloom and doomers out there, stock markets making new highs. Things seem really terrible, right? Well, maybe, maybe not. So what's going on in this crazy economy? Why are the stocks making new highs, but people talking about how the economy is terrible? And both of them being accurate at the same time. Pretty weird, right? But they actually kind of are. Earnings are good and companies are continuing to grow, which is why you see the markets making new highs. At the same time, inflation is really hurting people and the economy is really tough on a lot of people, causing there to be a terrible economy at the same time. This is actually causing a bit of the soft landing the Fed was hoping for. Hopefully, we don't have bigger problems where the gloom and doomers become right. We see some big collapse. But at least for now, that doesn't seem to be what's going on. The first thing I'm going to talk about to debunk some of the economy's terrible and we're going to see a big crash is the real estate market. Because to be fair to the people who are negative on it, prices are high. Interest rates have gone up a lot, even though historically they're actually at a pretty fair level. And I don't see a lot of that changing a whole lot this time. So let's go back to the great financial crisis of 2007 and 2008 and what was going on and why we had a collapse back then, or a major factoring reason as to it. So back then we had these loans that were available called the option arm. The option arm gave people an opportunity to make four different types of payments. They could either make a minimum payment, which was actually negatively amortized. And what that means is they're actually adding on to the principal value of the home of what they owe. If I said that kind of weird, let me explain. So if you buy a $300,000 house and you put 5% down, so you put down $15,000, you owe $285,000. Simple math. I've left out a lot of things that could change all of that. Anyway, on your $285,000 balance, if you were making the minimum payment when you had that option arm loan, each month you would actually be adding on to the amount you owe of that principal. On a typical traditional 30-year mortgage, you make a payment, a little bit goes to principal, and a lot goes to interest in the beginning, and that slowly reverses over time. The option arm gave you those four different options. The minimum payment was negatively amortized, meaning you added on to principal. Then you had an interest only payment, which is exactly what it sounds like. You're making the interest payments and you're leaving that principal balance the same. Same scenario, same house. So if you owe 285,000 and you're making the interest only payment, you would continue to owe 285,000. And usually these loans had a 5-year seasoning period or until they converted into a traditional loan. So after the 5 years, you wouldn't have all four options. Option number three was paying a normal 30-year payment where you're paying the principal and you're paying the interest like you would on most loans that people are used to. And then the one that was the most expensive was typically a 15-year payment to get that home paid off quicker. The real problem with these loans was the lack of understanding in who they were being sold to. It's actually a pretty good product because if you're selling it to somebody who's flipping a home, they may want to take advantage of that negatively amortized option because they're flipping the home, and if they add a little bit to the principal value while they're fixing up the home and relisting it to getting it sold, their goal might be to have the smallest payment option available. Like they may want to make the lowest amount of payments, fix the house, get it on the market, and get it sold. Then it gives you the option of paying normal payments or even getting ahead on it and doing whatever you want. It A wasn't explained real well, and B it was sold to everybody because people who sold these loans can make a lot of money on the commissions. There was all sorts of ways on the front end of the loan and on the back end to be able to make extra money. They could even do it where they gave a loan for the down payment on top of it. So people were coming in and putting no money out of pocket to be able to buy homes with these very low payments because they were adding on to the principal balance. Most of the people getting it, like if you just think logically, when they get the thing in the mail that comes in, and gives them four different options. And I'm totally making up numbers, so just ignore it, but it's just for demonstration. And you see, I can pay $800 a month. Hmm. I can pay $1,100 a month. I can pay $2,000 a month, or I can pay $3,500 a month. Most people are going to opt for the lowest payment. And they didn't really understand it would ever change. They didn't really understand that that was adding on to their principal balance. They just saw these four different options and thought, well, why would I pay more? At least that's my guess as to what was going on. The problem with that is if the housing market ever corrects and you've put no money down into a house, same $300,000 home, let's say it drops to $250,000 when your loan is now maturing or seasoning and you're being pushed to only make the 30-year mortgage payment, and you've probably added on to the principal balance, so your actual payment's going to be much higher than that minimum payment was. Well, you're now being pushed to pay 2000 and change a month instead of 800, and you go to look around and you notice, wait a second, I owe $305,000 on this home that's only worth $250,000 now. And that's a, mild case because houses corrected a lot more than that. Why would I keep this home with these higher payments than I used to pay, and it's worth less than actually what I owe on the house? This is what I think caused the house's market continue to tumble, because as that person thought, forget it, I'll just get out of the home, I'll give it to the bank, there's no reason to continue to pay for it. It pushed the prices even lower, causing a bigger problem. Now, fast forward to today, where people refinanced and got into these interest rates at sub 3%, and easily a lot of people in under 4% mortgage rates. Even if the housing market corrects, they don't have that option arm in place anymore. So they've locked in these low interest rates. Even if their price in the same scenario goes from 300,000 to 250,000, with the higher interest rates, it's probably pretty difficult for them to move and get into a home for a lower payment. It would make more sense now to keep that home, even if it's worth less than what they owe, approximately what they owe, whatever it is, plus or minus, since their payments are so good and there's really an inability to be able to get out of that house and find something for less expensive or less cost on a monthly basis. Much different scenario than it was previously. Now, that doesn't mean we may not see a correction in price. It doesn't mean that we may not see rates come down, but it really means there is no reason we should see panic selling. Now, keep in mind, real estate is really localized. I see what's going on in Florida, and I'm sorry to see what's going on because those hurricanes are terrible. But I do think that that's going to cause some selling. And then you add on it to the HOA problems that they've had because of the building that collapsed years ago. And then you add on the higher insurance rates because so many places have left and insurance prices are going through the roof out there. Their costs are going up significantly on a monthly basis. If you see more and more properties come to market and you've already seen a big increase, you really could see prices drop dramatically, which, if you're looking to buy, could create a good opportunity. But if you're looking to sell, you could be in a tough scenario. But if you're not in areas that are having some things go on to bring that inventory and cause a correction, then I just don't see a big collapse in housing happening the same way that it did back then. And trust me, I get it. Prices have gone up a lot. 2008 is not that far away. And when people have pain that they feel, they remember it really well. So they're super concerned. They don't want to go through it again, which is also another reason we probably don't see it is when people are aware of things and are nervous we're going to have a correction, chances are it doesn't happen. It's only when you don't expect it, it comes, and that's what we see. And keep in mind, I do mortgages for a living as well. And business is off probably 70% from where it was a year or two ago. Well, that's really significant. I mean, think about if your income was cut 70%. More than half of what you made a year or two ago is what you're making today. I've seen a lot of people leave the industry. There's a lot of difficulty going on. And I'm sure some of you think that's kind of funny because you think realtors and mortgage people make too much or whatever you think about it, which I also think is kind of funny because if it's such an easy job and people make too much, well, I don't understand why people sit there hemming and hawing in the comments and don't just go do it if it's that simple. It really isn't. That's a bit of a hint. And I don't really see a big influx of demand coming back as things continue to slow, which is why I say I do think we'll see it slow. I think we could see a bit of a correction. I could see whatever. I also don't really see rates falling that much, which is kind of interesting. I think as the Fed continues to cut rates, where there's a disconnect there is that doesn't necessarily mean the long end of the yield comes down. And we've seen exactly what I was suggesting a while ago coming into play. You're seeing the short end of the curve come down and the long end stay higher, which is causing mortgage rates really not to come down as the Fed's cutting rates and the yield just uninverting. Now, if they nail it, that'll continue to happen, and you'll see the economy chug along. You'll see a normal yield curve. You'll see mortgage rates stay in the sixes, which is approximately where they are now, and the economy just keep chugging along at a slower pace. What I do worry about, to be fair to them, is this discrepancy between the haves and the have-nots. Because I can't believe how expensive things have gotten either. When we go somewhere, everywhere I go, it doesn't matter. Stuff's expensive. The inflation hurts everybody. And if you're on a fixed income or if you're in somebody who doesn't have a lot of money coming in, the things that get more expensive, it makes it really tough just to survive, let alone save. Now, my son and I were talking about this yesterday, and I think this is a really important way to try to save for the future. What I talked with him, and he's only 13, so think about this. We talk about this even at a young age. And I've thought of volunteering time at some of the underprivileged schools to try to talk about kids who don't get the financial education. I don't know why I haven't. It's just sheer laziness, is honest answer. But I said to him, whenever you get into the career world, whenever you start working, even if it's a side job or whatever you do in college and high school and anything else, the first thing you do when you get a paycheck is you take 20% of that money and you put it away in some sort of investment, even if that means putting it um, into your checking account separate from the money you use for spending. And then you pretend you make 20% less than what you do. So let's use an easy number. Let's say you make $1,000 on a paycheck. $200 of that money should go into an account separate day one. Why? Because you're the easiest person who's not going to complain if you don't get paid. Meaning, you have an extra bill come along, something comes up that costs extra. It's easy to think, next month, I'll just skip this month, I won't save. No, $200 straight into that account for the future. And you live off the 800. Why? Because if you have to make your rent payment and you don't quite have enough, or if you have to make that credit card payment and you don't quite have enough, they're going to cause you a lot more problems than you skipping yourself. So you'll do what you need to do, meaning you'll pick up a second job if you have to, or you take on a roommate, or whatever it is to stay ahead and keep up with those other payments because they're going to complain more than you will to yourself. And if you don't pay yourself first, you'll find yourself in the future with a problem that you haven't saved up. And it only takes little amounts over a long time to be able to really have a nice nest egg to save. What people really struggle with is it really takes 30 years or 40 years of savings to have that nice nest egg to be able to be in the position where you don't have to stress so much about what am I going to do for retirement. And that's such a long period that it's hard to focus on that on a day to day basis when life really happens in the now and you don't know if you're going to get hit by a bus and maybe I don't enjoy it and all these other things. But I can tell you from somebody who's getting older and getting to that point where I hope to retire shortly that it's nice that I really pushed to do that stuff. And the more you save, the earlier you get it, the longer you have it, the better it does. And I'm going to use the same story I've told multiple times. Because when you think of the time frame of how long that money took to grow, that's really what it took. So back in 1988, so we're in 2024 now. So 24 plus 12, 36 years. Hopefully I did the math right. I really did it on the spot there. I'm guessing just based on timeline that my grandfather found out he was had cancer. This is a long time ago. It's why I can talk about it nonchalantly. I really love my grandfather. I miss him dearly, but it's been a long time, so it's taken a lot of time. Anyway, he gave each of his grandkids $10,000. My mom took it from all of us. We were pretty young. She didn't want us to go buy something stupid, and I'm sure she thought I would have bought a motorcycle because I liked motorcycles. I'd gotten my motorcycle license, and she probably didn't want me getting run over and killing myself. And thank you, mom, because probably a good thing. But my brother, my two sisters, nobody really said anything. She put it away for everybody, and I went to her and complained, I want my money. And she looks at me and kind of gets annoyed, obviously, what do you want the money for? And I guarantee I shocked her pretty significantly when I said I want to buy stock with it. And I remember her face. And she says, okay, well, go write the companies down. Let me know what companies you want to buy. I wrote down 5 companies, and God forgive me, I can't remember one of them, but I wrote down Eastman Kodak, Chrysler, General Electric, McDonald's, and the one I can't remember, which is driving me nuts. And she looks at my list, and I probably had others on there, but those are the ones I wanted to get. And she looked at it and went over it with my stepdad and thought, okay, no problem. She helped me open an account at, I think it was Schwab back then, because they were one of the few places you could buy stock for cheap, which is another story. You used to pay like, I remember the first time seeing a commission check or commission charge to buy like 100 shares of a $50 stock, and they charged like $400, and that was a discount, which is why people just bought and held. It wasn't free to trade. Anyway, totally separate story. The point of my story is in those 36 years, Eastman Kodak went out of business, Chrysler went out of business, the GE that comes across your ticker symbol, I am pretty sure went to zero and restructured. I didn't keep on top of it. I don't remember exactly what I did with General Electric, but I know I used to get a pretty good dividend on it because I remember at one point it was even over $100 a quarter because I looked forward to that dividend. Um, and then McDonald's. I bought McDonald's. I bought 100 shares for approximately $22 a share. 1988, $2,200. It is split 3 times since then. Now, the idiot that I am, each time it split, I sold 100 shares because I was all too excited. I bought a computer once. I think I did buy a motorcycle once because it was around $50 a share, and I could, but so my mom could slap me for doing the stupid thing she didn't want me to do with it. But if I had kept that, my 100 shares would be 200, my 200 shares would be 400, and my 400 shares would be 800. And I did this with my son too. We went over it yesterday as well when we talked about leaving it over the long term. 800 shares of McDonald's that closed at $305 a share on Friday. $244,000 from a $2,200 investment. Even if you call it the full $10,000 investment because the other ones went to zero, that's decent return over the 36 years. It is the time that was valuable. Also, keep in mind during those 36 years, there were plenty of times, either 3 or 4, where McDonald's fell by more than 50%. So you had to hold it up, hold it on the way down, hold it up on the way down, and eventually it turned into a good amount of money. The time you have money in the market is more important than timing the market. Even think about the great trades that Charlie Munger and Warren Buffett have done over the years. Take Coca-Cola for example. Great pick. Well, do you really think it would have mattered if he paid 50% more than what he paid for the stock? It was the time that he had it in the market. We give so much credit that he's done so incredibly well, but really all he did is pick some decent companies and stick with them over a long term. Apple for him was really fortunate that he bought it at the right time and didn't have to hold it quite as long. But most of his positions are just good companies that he bought when they were out of favor, which is really smart, but he held them for a very long time and they've performed. Now, back to the original point of gloom and doom and what's going on in debunking things. Now we can talk about the late 90s, early 2000 with the internet bubble to talk about where stocks really aren't so overpriced. And even if they are, I would still rather people investing and buying them and saving for the future than worrying about the impending collapse that's coming. During the late 90s, early 2000s, when we had the internet bubble, people were paying anything for any company that sounded interesting with a .com at the end of the name. They had no earnings. They had no revenues coming in. They were just a name and knew how to do a website because in the future that was just going to be the greatest thing. You could almost compare it to what's going on with AI right now, except here's the problem and what's different. Most, I would be careful about the companies you're buying, of the companies today that people are buying because of it. They have earnings. Not only do they have earnings, their earnings are growing immensely. Take Nvidia, that is so overpriced because it's gone up tenfold over the past whatever months. The reality is, I think it's trading like 35, 40 times over forward earnings, which don't get me wrong is a little expensive, but not for a company that's crushing it at the rate that they are. In fact, even at $135 a share where it closed on Friday, and I think it's getting to the higher end of the range, I think it's the higher end of the range, and it's probably a company I would want to own, even if I overpay a little bit for it. I don't mind overpaying for a company like Nvidia that is in the heart of the AI boom, growing at an immense rate, and has the potential to potentially continue to grow like that because at least for now, they're the only place to get the chip that the companies want. Now, there will be a time where there's competition, but at least for now, there isn't really. So that's going to continue to let them get ahead. And the longer that they're able to get ahead, the more those earnings are probably going to continue to grow. Now, I'm going to do my usual spiel, so forgive me. This is not investment advice. Please don't listen to me. Use my information for entertainment purposes only. You need to do your own research when making your own financial decisions. I'm just some idiot on YouTube who talks about the things I like. So by all means, you figure it out for you. Just listen for me, see what you think. If you have fun for it, great. But do your own research. Anyway, I want to own Nvidia. I want to own Amazon. I want to own Google. And if I think they're way overpriced, like I do with Costco, I think it's super expensive for where it's trading, but I still want to own some. If I think it's overpriced, I will buy a tiny amount so at least it's part of my portfolio. Then from there, if it gets to where I think it's fairly priced, I will continue to add on. Now keep in mind, if it's getting to where it's fairly priced, I better pay attention to what's going on because they should stay overpriced if they continue to be a great company and continue to outperform. That's why it's okay to buy a little of it when it's overpriced. Now, don't go all in and put all your money into anything. Again, just my advice, do whatever you want to do. But there's no reason not to own a tiny bit of Costco if you think it's super expensive instead of having none in case it continues to go and you just never end up owning it because it's always too expensive. Again, I want to own the best of the best. And right now, to me, Amazon, Google, Meta, Nvidia, Costco, Tesla, these are all the companies that continue to outperform. Now, I have been doing my best to narrow my portfolio down. It's like I look at some of the holdings I have and I still like them, like Pfizer, for example. I think Pfizer is going to do just fine. It has nothing to do with that company coming in and buying $1 billion worth. That's just all noise to me. But I think they make enough money. I think they're paying a nice dividend. I think odds are they'll probably go up. But if my goal is to outperform, well, do I really want a company like Pfizer in there that even if they do well, I'm not going to really do what I would like to with my portfolio? Now, I still own Pfizer for full disclosure, and I went over again, 13 years old, but talked to him about the same thing. That as your portfolio grows and you have money you need to protect, you can't put it all in things like Meta and Google and Amazon. You want to own some things like Pfizer's to protect it so that you're spread out a bit. But then here's the question with that I struggle with myself. At that stage, are you better off just buying QQQ and SPY because now you have diversified with only owning two things? And what I told them yesterday, my wife and my son, because I am getting older, I said, look, if I get run over by a bus tomorrow and you guys don't understand the markets, you sell all the portfolio and you put 50% in QQQ and you put 50% in SPY and you don't worry about the rest. Why? Because don't think dad knew something and leave it in the investments I do, because I might have bought something because I just think it's undervalued today, not because I think it's such a wonderful company. So why is this time different? Because the companies have earnings this time. Now pay attention to what you have in your portfolio, because if you have those ones that are just AI based and they really don't have earnings, I'd be a little cautious that they may have some huge correction. You know, in the internet bubble, the Nasdaq fell by like 90%. 90. So that's what people are worried about. These corrections are not that long ago that nobody remembers. And even in COVID, when we had the market drop, that it rebounded so quickly. These were big corrections that people are sensitive to, so they think that the world is ending. Now, what is real? People are struggling. Credit card debts are at all-time highs. We have potential of wars going on, and we have wars going on, but we have potential of them expanding and getting much worse. If it gets much worse in the Middle East, you'll see oil prices skyrocket. If it gets much worse in Ukraine, you'll continue to see food prices go higher. And it's also about all sorts of things with controlling ports and concern that we're going to control oil, which energy is such a big deal because AI and what's going on and the demand for it is just going to continue to grow. So you have all these scary things going on, but that doesn't necessarily mean that the gloom and doomers are actually right. Until I get into the position where I go to the grocery store and the person checking me out is talking about, their stock investments or their housing investment or whatever it is. Or I go to, back in Chicago, the high rises when I visited friends and the doorman would say something. Until it really is just a natural discussion everywhere I go, I don't think we've gotten to the top. What I do worry about is a bigger delineation between the haves and the have-nots, because if we melt up, that's a much bigger problem than if the economy just chugs along. And I do see potential for that. Even if the Fed starts cutting rates quickly and people get overexcited that they've eased up the liquidity and now they'll be spending and the economy is going to grow and things like shoot up in value, and then the earnings don't keep up with it quite right because the markets get ahead of themselves, which they tend to do, which we just saw when they cut rates, how the bond market reacted. If the markets get way ahead of themselves because they have this anticipation that all's great in the world and you see this huge rush of the markets go higher, to me, that would probably be an opportunity to sell. And I would be worried that we would have a big correction after a big run up like that. So keep an eye for these things. Watch the markets, pay attention, be aware. But I don't see that crash coming the same way. One interesting thing, I don't know how many of you were able to see the Tesla report. It was so boring, I fell asleep during it. And did they even really say anything? I mean, all he did was go up there and get some rahs and hoo hoo and everything's great. But they really didn't give any timeline or tell us anything about what to expect in revenues or things of that nature, or even how it'll work. Because I was surprised when they said that the robo taxi would cost $30,000 a car. Like, are people buying them and then leasing them out back to, like, I don't know how it'll work. It'll be interesting to see. Now, that being said, that's why the stock corrected is he didn't really say anything. And you take into account that both Google and Amazon have been on the road already for close to 2 years in San Francisco and other places. They're getting a big head start in this race. Now, I do have one concern about the autonomous driving, and I mean it, it's a legitimate concern. We have a lot of people who left their jobs and started doing Uber and Lyft and things like that for themselves. As we have the autonomous driving and they slowly displace all these people who moved and transitioned into working for themselves, going to be really difficult for them to transition back into the workplace. They've had years of driving, picking their own hours, deciding when they wanted to work, how they wanted to work, not having to listen to a boss tell them, I need you to do this. That makes it very hard to go back to a regular job and work for somebody and now have a boss who tells you what to do. I don't know how long it'll take to transition into it or if it'll be really quick once the approvals start coming and they're able to grow those businesses. But I actually do have a concern about all of those people working those jobs as to what they're going to do from there. Even just a regular something that they think, I don't want the stress of a boss being on top of me. Whatever it is, they're going to have a boss telling them something to do. It's going to be a tough transition. And debunk number three, even though we've been kind of scattered. If you've missed one and two, it's the housing market. Number two is the stock market versus the internet bubble. And let's talk about the commercial real estate because there are real cracks in the system there. The weird thing is a personal understanding with somebody I know who had a bunch of properties and sold most of them, so it really doesn't matter. He cashed out, he's pretty much done, but he's still quote unquote stuck with three buildings. Well, interest rates have gone higher. The rent flows don't make sense that if they want to refinance them, like the math doesn't make sense. The way that it works on commercial buildings is essentially they take how much money is coming in rent versus how much you would owe in a mortgage. And as long as the rents are covering what the mortgage payments are, you should be able to qualify for that loan. It's a different type of structure. They don't really look at the same type of scenario. If you're familiar with what a debt servicing loan is, even in regular real estate, those are very similar in the same product, just on a commercial space. And what's happened is if you're getting $1,000 in rents and your mortgage used to be $600 and now the interest rates have gone up and you're still getting that $1,000, but the mortgage payment would be $1,500, well, all of a sudden you don't qualify. So the friend goes down to the bank. They say, well, we're not able to refinance you because the math doesn't make sense. And he says, that's okay. You can have the building. And they go, no, 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 no. We don't want the building. And he says, okay, well, what do you want to do? And they kind of look confused and they're like, well, you need to come up with more down payment to make the math work out. And these are what are called non-recourse loans. So if you lose the building, they can't come after you personally. And he kind of goes, well, I don't really want to do that. So you can have the building. That's fine. And they go, no, 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 we don't want the building. And he's like, okay, so what do you want to do? They're at this bit of a stalemate, and what they have done is they've essentially said, well, just keep making your payments as to what they were at the lower interest rate when the math made sense before, and we'll just continue like nothing matters. And he looks confused and says, yeah, but the mortgage is up. You're supposed to refinance. And the real answer is they don't want the building. He's correct. It can't refinance because it won't make sense in terms of what's needed for the ratios to qualify for a sellable mortgage or sellable loan. So they just have him paying even less because it doesn't work for now. And at least from the bank standpoint, they'd rather be collecting some money than taking over the property. And they're just going to continue like that until one day, hopefully, the math makes more sense. Either the rents will go higher enough that it'll make sense at the higher interest rates, or the rates will come down to where it makes sense and they can refinance. And in the meantime, he's in this limbo spot and he really doesn't care. He's retired, doesn't pay attention to them, and he's fine if the bank takes it, and he's fine if they don't. But for whatever reason, they're just not going to foreclose. They're going to continue to take the wrong payments and pretend like nothing happened. I'm guessing that's going on a much bigger scale than his three buildings. That anybody who's in that position, that's kind of the position that they're in. The banks aren't going to want the property and they're not going to want a management and they don't want to have some huge collapse. So make your payments, continue collecting your rent, and we'll figure it out in time. Kind of crazy. But I think that's what catches the commercial real estate is they already know, and you're just not going to see any big correction there either. So this is why I don't see any major catastrophe coming. There'll be fallout. The economy might continue to slow. If you see unemployment start to go crazy, of course, you'll have problems there. But for the most part, things are chugging along and it just sounds real scary. Anyway, before I forget, hit that thumbs up button, hit the subscribe button. If you've made it this far, by all means, make some comment in the video. On average, what do people make it like 2 or 3 minutes into a video? Myself included, even the ones I like. It's made me such short term memory. Um, have a great week, and maybe I'll do another video. We'll see. Thank you. Bye bye.